Assalamu alaikum, my dear students. I am Sadia Hussain, lecturer, Department of Finance and Banking. Today I am going to discuss chapter 6, Cost of Capital. My dear students, today I am going to discuss chapter 6, Cost of Capital. At first, we have to understand the concept of cost of capital. Cost of capital is the cost of funds gathered from different sources. Cost of fund is the minimum amount of money that must be earned to meet up the expected return of investors. That means the amount of money that is to earn as minimum to meet the expected income of the owners of the fund collected from different sources is called cost of fund. Significance of cost of capital. Cost of capital plays an important role in taking different decisions in the financial management of a company. Cost of capital is applied to all steps starting from choosing the right source of financing according to the need of the company to the assessment of the investment opportunity or evaluation of the project. The significance of cost of capital is furnished in two categories. First one is investment decision related. Suppose that a company sets up a factory taking 50 lakh taka loan from Sonali Bank at the interest rate of 18%. After commencing the factory, it is found that the business is being able to earn at the rate of 10%. Which is less than the 18% rate of interest of the money indebted to Sonali Bank. As a result, the company will not be able to repay the money of Sonali Bank. In this situation, the business will be unfruitful. Therefore, it is an unavoidable duty to know the cost of fund and then take such investment decision so that it is possible to earn more income than the cost of fund. Therefore, it could be said that the right calculation of cost of fund is the precondition of right investment decision. Then, second one is capital structure related. Every organization has a desirable loan policy. Desirable loan policy means what portion of the capital a company will collect from borrowing or loan. In a business firm, the equity portion of the owners is called total capital. A company may choose to collect total capital at any ratio, such as 50% of own capital or equity and 50% loan, or 60% own capital or equity and 40% loan. The company has to assess the cost of the capital structure of every such ratio, and then it has to accept that alternative of capital structure where the cost of capital is minimum. Therefore, cost of capital bears significance also in selecting the capital structure of the business. Another important topic which is also related with cost of capital. Opportunity cost is associated with use of own capital in business. Opportunity cost is the probable income lost from any project because investing in any other project. If any business invests its capital in other project from where 10% return will be received. But because of investing that capital into own business, 10% return is lost. As a result, opportunity cost happens. Loan given to friend by selling land is related with opportunity cost. Opportunity cost is the probable income lost from another project after the actual investment made. For example, the selling amount of money of land can be invested in project, from where the investor can earn some return. But by lending to his friend, he loses the potential income. This refers to opportunity cost. a brief idea of cost of capital of different sources. Cost of loan capital. The cost of debt is the rate a company pays on its debt, such as bonds and loans. Formula of calculating cost of loan capital. Tax adjusted cost of loan capital equal to pre-tax cost of loan capital into 1 minus tax rate. Cost of preference share. The cost of preferred stock to a company is effectively the price it pays in return for the income it gets from issuing and selling stock. The formula of calculating cost of preferred stock equal to dividend divided by sale value per share into 100. Cost of general share. The cost of share capital means the rate of expected income from the dividend of the investors or shareholders and the profit gained from the increase of share price. Cost of general share. For calculating cost of general share, we can use zero dividend growth model or zero dividend increase model, which is it is an easy way of calculating cost of capital. In this method, it is supposed that the company will announce the same dividend in future years as that it has given in the current year. That means there will be no change in the expected dividend of the shareholders. For example, if a company gives 10 taka dividend per share, it is supposed that the company will give 10 taka dividend to the shareholders in future years also. In this method, if the dividend per share is divided by market price of the share, we get cost of general shares. Here are the formula. Cost of general share equal to dividend 1 divided by share price into 100. Another model of calculating cost of general share, dividend increase in fixed rate method. In reality, such companies are very rarely found where there have been no chances in giving dividend in future years. Usually, companies give dividend in different years in different rates. Dividends increase in fixed rate is such a method. Here, it is supposed that a company does not give equal amount of dividend every year. However, this method has some inferred conditions. It is supposed in the conditions that the company's dividend will increase every year and the rate of this increase will remain the same every year. Cost of general share capital can be calculated by applying dividend increase in fixed rate method. Here the formula is cost of general share equal to dividend 1 divided by share price 0 plus rate of increase or rate of growth into 100. Cost of reserve fund. One of the sources of financing a company is its own reserve fund. The company does not distribute the whole amount of money that it makes profit as dividend to the shareholders, but retains a portion of it in its own fund. Retained earning is the undistributed profit of net profit after dividend payment to shareholders. Though it is assumed that retained earning has no cost, it has opportunity cost. If retained earnings was distributed to the shareholders, shareholders can invest that money somewhere else from where they can get return. As retained earnings is not distributed, shareholders are deprived of that income. This is the opportunity cost of retained earnings. My dear students, that's all for today's class. If you have any kind of questions or queries, you can call me or we can discuss it in our Zoom class. Allah Hafiz.